On the Express this week, the government shutdown enters its second month with no end in sight. Hey, big spenders, big tech keeps making it rain out there. Are we partying like it's 1929? Andrew Ross Sorkin drops in to talk about what really caused the greatest stock market crash in history and the similarities and differences between then and now. Is that why everyone's talking about the Hindenburg omen lately? We'll get into that. We'll talk about the Investopedia indicator and what to watch this week. Microphone check 1 2. What is this? It's the Investopedia Express, and it's time for business. Aboard to all of our viewers and watchers watching us live around the world. Shout out to you all, the smartest investors on planet Earth. We are the Investopedia Express live every Monday at 10 a.m. and then on demand on your favorite podcast network. Shout out to all of our people around the world. We know you're out there watching. We know you're out there listening because we love it when you chime in. Keep up those comments. We got a great show in store for you. But hey, let's get down to business because it is busy out there. We're entering the second month of the government shutdown. Day 34 today. The record, 35 days. That was set back in 2018. We're going to pass right through that. There is no end in sight to the government shutdown. And that means another round of paychecks missed by those furloughed government employees. First paycheck's a problem. Second missed paycheck becomes a crisis. A lot of folks suffering right now from a lack of paychecks and potentially more coming down their way. Plus, potential delay of SNAP benefits. Those are those food stamp benefits to over 7 million plus Americans. That may or may not get resolved this week, but that is serious for millions and millions of Americans and families out there depending on it. We got reports of FAA workers not showing up to the job at airports, which has led to flight delays, flight cancellations. There's your little map there from the FAA looking at airline traffic across the country right now, and fewer flights going out of some of the biggest airports in the country right now. We know that flight delays, flight cancellations, problems with our airplanes and problems with air travel, that really gets under people's skin. And as we get closer and closer to Thanksgiving, and I don't want to be no turkey this close to Thanksgiving, this could be the thing that actually breaks these talks open and maybe gets them back to the negotiating table, because Americans don't deal well with lack of the ability to not fly when they want to fly. But don't tell investors. We're busy over here stacking returns and stocks dancing around near record highs despite the shutdown, despite concerns about everything else going on out there. Stock market still dancing near record highs, and it is being driven by the spenders. Investors, we're focused on the numbers, and the numbers have been really big lately, especially when it comes to AI capital expenditures. We've been talking about this all year. We've been talking about this for the past couple of years. The biggest companies in the world are spending $350 plus billion this year on building out their AI infrastructure. They do not see an end in sight to that themselves. It's a zero-sum game for the biggest tech companies in the world. And you keep hearing this word compute, these words, compute power, over and over again in the earnings calls, or when you hear these big tech deals, these mega cap tech deals. They need more compute power. What is compute power? The ability to process our information with AI in massive data centers. And that is why you are seeing huge revenue boosts for the biggest tech companies out there with the biggest cloud storage companies. Here's a good chart from our friend Charlie Bilello on just revenue, trailing 12-month revenue for the biggest tech companies out there. You got to look at companies like Amazon in terms of the amount they're making just from Amazon Web Services. That's over $691 billion. Apple using AI and spending a lot on it, but also getting a lot of revenue from their devices. You're also looking at Meta, Google, $385 billion, Microsoft, $295 billion. What does it translate to? Great chart here from our friends at the Compound, Chart Boy Matt putting out the good. We're at Ritholtz Wealth in the Compound there. Look at the revenue growth of the biggest companies, or three of the biggest companies in the stock market. Meta, Microsoft, and Google. What do they all have in common? Massive storage, web storage, and cloud computing companies. We've got Amazon, obviously, with Amazon Web Services. You got Google Cloud, and you got Microsoft Azure. And we're going to need more and more compute power if you listen to these big tech companies and the AI companies. And compute power means revenue for the biggest companies in the stock market. And guess what? You own them all. So the more they spend, the higher they go. And that is just translating into higher and higher stock prices. And are you not entertained? Come on, where's my guy? There you go. There's Cosmo. We are entertained, Maximus. We are highly entertained by all the spend, the AI spend, the revenue growth, especially in that part of the market. That has been driving returns, and it's turning into the land of the giants all over again. NVIDIA surpassing the $5 trillion market cap last week. First company to ever do it. NVIDIA's Jensen Huang steering his company from 1993 all the way to 2025, the end of 2025 today. That is a $5 trillion company. And why? They are selling the chips to these big cloud computing companies for processing AI mega computing right in the middle of everything. Jensen Huang and NVIDIA, $5 trillion last week. But on the flip side, we got a lot of companies announcing layoffs. It's really a tale of two economies. It's a tale of two stock markets, and it's getting more and more pronounced. Companies announcing layoffs in just the last week or two. Amazon announcing 14,000 layoffs. Got a lot of employees, but still, that's a pretty big cut. Paramount announcing layoffs. UPS, ConocoPhillips, Target, GM, and more. So we're hearing more and more from companies that they're shedding workers, trying to improve their margins. Remember that metric we've been talking about, revenue per employee. That is what has been driving returns. So tale of two markets, tale of two economies, and that's where we find ourselves today. All right, let's roll it back. Nearly 96 years and just a few days ago, the Dow Jones Industrial sank a dizzying 25% between Black Thursday and Black Tuesday of 1929. The sell-off wasn't even close to being over as the stock market fell a face-ripping 89% from its peak in September of 1929 to July of 1932. Can you imagine those types of losses? That's a near 3-year bear market that triggered the Great Depression. Unemployment soared to 25% and industrial production was cut in half. It took until 1954 for the Dow Industrial Average to regain its 1929 peak. That's 25 years, folks, a quarter of a century. You think 2025 has been volatile over the last couple of weeks? How about 2020? How about 2021? How about 2008 and 9, 1999? They have nothing on 1929, which until the crash was looking like another banger year for the ragingly popular stock market and the millions of Americans who leveraged their way into it in search of quick riches. Those flames were fanned by rampant speculation, unfathomable greed, slippery stock tips, and smooth operators looking for an edge anywhere they could find it. Sound familiar? It does to me too. But I had no idea how many things are eerily resonant 96 years later and the dynamic characters and events that shaped the year 1929 until I read 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. The terrific new book by bestselling author, CNBC anchor, the founder of DealBook for the New York Times, the first ballot business journalist Hall of Famer, Andrew Ross Sorkin. And he is our very special guest on the drop-in this week. Andrew Ross Sorkin, thank you so much for joining the Investopedia Express. The book 1929 is incredible. I've been dragging it all over town on the skateboard, reading chunks of it whenever I can, and I am just so fascinated, I'm sure everyone is, with some of the parallels between almost a century ago and today. But the big one is this period of the Roaring Twenties, this period of speculation. Talk to us about those similarities as they appeared to you over the 8 years it took you to put this great book together.
Well, the truth is that there is a remarkable amount of euphoria right now around AI, for example. And there was a remarkable amount of euphoria back in the 1920s around new technologies like automobiles and telecommunications and the prospect of radio. And so that sort of animal spirit that existed in the 20s, I think, is so very evident today. And on top of that, there's this idea of democratizing finance. You oftentimes hear that phrase today. That was the phrase that people used back in the 20s about giving people more and more access to investments, trying to get the ordinary American into the game. We talk a lot about that today. Everybody wants their chance, their opportunity at the lottery ticket. And so I think the combination of those two things, frankly, and a little bit of leverage, so hopefully less leverage today than there was then, I think makes some of this a little nerve-wracking. We'll see.
Yeah. It was also really the birth of kind of the consumption economy, right? When you're talking about the consumer economy, we're moving off farms, we're moving into cities, which translated, as you point out in the prologue, to the birth of credit. And the birth of credit leads right into the birth of speculation, because if you can buy now, pay later, whether that's you're purchasing a car and you're financing it, or you're actually doing it with stock, which was incredibly rampant at that time, that opens the door to a lot of things.
Well, look, so much of what happened in the 20s, and frankly, what's happened in our entire economy since then, has been powered by credit. It's been powered by debt. It was a moral sin in America prior to really 1919 for people to take a mortgage, people to get a loan. That was not something that people did. And it was in the 20s where that became a socially acceptable practice, more than socially acceptable, socially almost enviable practice. And that's really what led people to get in the game. The other thing you mentioned about the consumption economy, the consumer economy, I mean, so much of our economy is built off of that today. That also started in the 20s. And I'll give you a little uh, sort of nugget, which I found so fascinating. A guy named John Raskob had an idea in the 1929 that we should have a 5-day work week. Actually, back then we had a 6-day work week, but it wasn't because he was such a nice guy and thought that we should have a weekend to ourselves, not to work. It was because he thought that you could have a more consumption-led economy if we had 2 extra days, because you'd have time to travel, you'd need to buy more vehicles, you go buy gardening equipment, you'd need different types of outfits because you'd be doing other social activities. So there are these sort of very unique moments in the 20s that I think very much exist in our economy today because of the things that happened then.
Yeah. So we were talking about the democratization of finance and investing, but the fact that there was this availability of credit. You could literally go to the bank, borrow money to buy stocks, and some of the biggest banks in the country were enabling this. We'll get into some of the characters that were driving that force. That seems nuts to me, although you can kind of do it today. There's a lot of margin buying, but there were so many people in America that were into the stock market. We think we're fascinated with it today. We have nothing on the roaring 20s of the 20th century.
Oh, goodness. I mean, people in major cities, there were brokerages springing up on the corners of streets like Starbucks. They really were. And you could walk in and, if you had $1, they would loan you $10. They would loan you $10. Almost sight unseen. I mean, you might have to, from a collateral perspective, there were people who, by the way, ultimately lost their homes and things because they put up their homes, but they had no idea. They had no conception of what all of that leverage really, really meant. Today, arguably, there's less leverage in terms of stock trading unto itself. But by the way, in the world of crypto, for example, there is enormous leverage. There are different options trades and things that you can do 20 times, 50 times leverage. So there are sort of a lot of things going on in today's market that do have similarities, but I don't want to take it too far.
Yeah. Well, also in this book, the Fed is right in the middle of this. It's only about 10, 15 years old, right? Created after the Federal Reserve Act of 1914. But the Fed plays such a major character in this entire period, kind of like today, but in a slightly different way. You had bankers on the board of the Federal Reserve trying to make the rules for how the system should work, and they had very different opinions, about what the role of a central bank should be. And that was pivotal in both the crash and then the rebuilding, which took years.
Well, for many years, we had bankers on the Federal Reserve, especially in the various regional Feds. Back then, the New York Fed and all of the different regional Feds controlled things much more than they do today. And so back then, you had a debate happening, by the way, similar to today. Should we try to raise interest rates to try to, stamp out some of this speculation? Should we lower interest rates? And there was this back and forth, and even questions about politicization. Not so much about President Hoover, trying to put the arm on them in one way or the other. I know people think that that's something that this president is trying to do with this Federal Reserve, but more in the context of just being so cognizant, so worried about the political pressures of the moment. When you go read some of the early diaries of some of the board members during that period, they were so worried they were going to get hauled in front of Congress if, in fact, they tipped the economy over by raising interest rates too high, for example.
Yeah, it's unbelievable how just the tension around the Federal Reserve, the central bank, there's nothing new to this. It's just it was so apparent back then, especially as it was really coming into formation. Let's talk about some of the characters. This book is full of amazing characters. In fact, the front of the book, you actually do right by the reader and say, here's the cast of characters you're going to meet throughout the course of this incredible event in our history here. And right at the top is Sunshine Charlie, Charles Edwin Mitchell. He's the chairman and CEO of the National National City Company and National City Bank, which is today's Citibank. This guy was building the mega bank before Sandy Weil was building the mega bank back in the 80s. This guy's the anti-Buffett almost. He's a banker. He's on the board of the Federal Reserve. And when the market starts tipping and sinking, he actually decides to put $25 million into it to safeguard it and prop it up. This guy's fascinating.
You know, he was as famous as Jamie Dimon is today. I mean, this was really the first time in American history that a banker, a financier, was on the cover of magazines and was almost like a celebrity. He was running what was the biggest bank in the country. He was trying to make it the biggest bank in the world. He had this almost, sunny optimism always. That's why they called him Sunshine Charlie. And he really was somebody who believed in democratizing finance and believed that the mystery around stock buying and the like should be removed. He used to talk about selling stocks the way we sell neckties. You should be able to walk in and buy them in a very similar way. And he probably almost singularly is responsible for the amount of debt and credit, frankly, people were able to take on. And it's one of the reasons he became the face of the crash as well, because people blamed that leverage and that credit for the problems. At the same time, the truth is that he really did put almost the back of the market on his own back, if you will, in certain times, and not only that, put the bank on his own back at certain times as well. And I don't want to give away exactly what happens, but let's just say he's a very complicated character. He ultimately gets arrested, but I won't tell you why, and I definitely don't want to tell you what happens after that.
Yeah, but you have to read it, folks. This guy is incredible. He's worth a book on his own. I'm sure there are several books on him. I know you cited several in your notes there, but basically he leads his actions and he becomes the focal point of the sort of the prosecution of all this after the fact. And then the Glass-Steagall Act was formed because of him, which we still have today. That's right in the middle of a lot of the conversations around banking regulation. A lot of these laws that were formed, including the, some of the trade and tariff laws. Smoot-Hawley was created back then, and we're still dealing with it today. So fascinating. All right, let's talk about Jesse Livermore, the boy plunger, celebrity trader, right? This guy's, memorialized and reminisces of a stock trader.
Yes.
Which is an incredible book. This guy's obsessed with the stock ticker. He is the modern day, or back then, the modern day, like hyper trader, hyper focused on the markets, tickers in every room and every office in his house, obsessed with the numbers. This guy's fascinating too.
Jesse Livermore was the most famous trader of the time. He really was a short seller. He was an emotional wreck of a human. He lived for the highs. He lived for the lows of trading. He was almost out of business, by the way, by 1929, because being a short seller during that period when the stock market was just on a runaway, high almost every other day, you couldn't make money shorting stock. He ultimately makes about $100 million in the middle of the crash, but sadly, 2 years later, basically loses it, makes a little bit of up again, loses it again. And I think people may know the end result. He ends up walking into the Sherry Netherland Hotel in 1940 and killing himself.
In the cloakroom.
In the cloakroom, no less. Yes.
I mean, who plays this guy in your version of the movie here? Who do you have cast already?
Caleb, I was talking to the casting director and they mentioned you, so I don't know how you feel about that.
All right, he's a little taller than me and total gunslinger. I'm a little bit more risk averse, but man, he is an incredible character. He's a poster child also for the rampant speculation, but a short seller. Yeah. I think about all those great short sellers who warned us about Enron and warned us about, some of the coming crashes. And I can't help but think about Jesse back in the day. But then he turns, he actually changes his tune a little bit and goes long.
Yes,
at a
he
time
goes long as well.
Yeah. He's incredible. Then you have Ferdinand Pecora, the hellhound of Wall Street. This is the prosecutor, right? This is the guy that is he's the chief counsel for the Senate Committee on Banking and Currency. He's a New York prosecutor, born in Sicily. Little guy, right? Tough guy.
Little guy.
Yeah, tough guy. Scratches his way through City College, the New York Law School, ends up working for the DA and starts prosecuting people like Giuliani did back in the mob days, like a lot of the prosecutors who took on, the bankers after the great financial crisis. This guy's fascinating as well. What can you tell us about Ferdinand?
What Ferdinand did really was put a spotlight on all of the manipulative activities that were taking place in the late 20s and really got the country to focus on the potential illegality of it, but even more importantly, the immoral nature of it. Because the truth was there were no laws prior to this, which is something I grappled with as I was thinking about these characters and trying to put myself in their own shoes in that moment. Because the truth is the markets to some degree are about, you know, outwitting the other person. That's what they are. You know, whoever's buying a stock thinks they're smarter than who's ever selling the stock. And who's ever selling the stock thinks that they're smarter than who's ever buying the stock. So when you look at and think about some of the manipulative efforts, including these things called investment pools, where people were really doing almost the equivalent of pump and dump schemes, back then, because they weren't illegal, insider trading wasn't illegal. I think that so many of them thought, and because it was rampant and almost out in the open, they thought that it wasn't immoral. They thought it was just part and parcel of with the same kind of conceit of outwitting the other side, if you will. And he really put a spotlight on this so that the country really turned and looked at Wall Street and said, you know what, this doesn't work. It shouldn't work this way. And it's actually, I think, a large part the reason we have a whole number of laws, including the creation of the SEC, Glass-Steagall, a bill, by the way, that broke up the banks that almost had no traction prior to Ferdinand Pecora's, hearings. I think it was that, and then obviously the Banking Act later, and so many other things. He almost singularly is responsible for that.
Yeah. Well, you did an incredible amount of research for this book. I'm sure you had a team helping you, but the research is unbelievable. But this guy was an unbelievable researcher too. Back in the day where you had nothing digitized, it was all orders were written on pieces of paper. He was following up on CEO salaries. Why did you pay this guy this much? Why did you pay this? This guy was an actual hound. This was a data hound. Imagine what this guy could do with AI today, or with the tools.
Oh my goodness!
Today.
Yeah, give him ChatGPT. They'd all be in jail.
He's an amazing character as well, and I love the names. The Hellhound of Wall Street. Here's another one. Evangeline Adams, the Wall Street Seer. This is a woman advising people on stock picks based on their zodiac signs, posting up in the nicest restaurants in town, people paying $50 to her to get their stock picks because of their zodiac sign.
She had a newsletter. More than 100,000 people had subscribed to her newsletter. Even J.P. Morgan, when he was still alive, he wasn't alive in 1929, used to go visit with her. She had an apartment on 57th Street, and people would literally go to visit with her, like you'd go to visit with a psychiatrist. Except, of course, she was an astrologer, and she would tell you what was happening in the stars and how it would relate to the markets.
Yeah, and she says at one point in the book, the stock market could climb all the way to heaven, right?
Famous last words. That call was in September of 1929, and of course, you know what happened in October.
Yeah, and then the flip side of the Wall Street Seer is Roger Babson, right? Who's the statistician. Yes. He's the economist. He predicted the crash. They called him, I think they called him the prophet of the prophet of loss.
The prophet of loss. The Babson break was what it was called. By the way, he created Babson University, famously, up in Massachusetts, and he was really one of the people, frankly, for years that had been a Cassandra in the room that people weren't really paying attention to. And then he made this, bold claim that the markets were going to fall in September of 1929. The markets actually dropped in reaction to his comments, but then actually came back and powered through for about 2 or 3 weeks. So there's always a question in my mind about how we should think about Cassandras and the timing of a Cassandra. Interestingly, as I was doing some of the research, Charles Merrill, who created and founded Merrill Lynch, told people to get out of the stock market in early 1928. And the truth is that he was right in this sort of cosmic sense. But if you look at where the market went between the beginning of 1928 and call it September of 1929, the market was up 90%. And so it's one thing to sort of recognize that there's a problem. It's another thing to be able to call the timing of it right.
Right. And yeah, as they say, a broken clock is right twice a day. But this guy was doing real research on price activity. He was looking at advanced decline, trends. He was looking at the stuff that we still look at today to say, this market's frothy. This makes no sense. There's only a few stocks that are rising and the rest of the market doesn't look that good. That sounds eerily familiar, but this guy's actually doing the research literally by hand at a time where, we didn't have a lot of data, and a lot of the trading was going on, of course, at the stock exchange, but there was all these investment pools outside of it, cigar chomping dudes with, the best
Right.
watches and drinking 3 martinis at lunch, talking about what to buy and how to make money off of this whole thing. This guy's out there doing the dogged research, and I love it. He's fascinating. And then there's other characters that flow through this book that are huge celebrities in the 20th century, but are also involved in the speculation. You got Groucho Marx in there. Everybody wants a tip, even the richest of the richest. That sounds familiar, Andrew.
The Groucho story, I think, is the ultimate sort of parable for what happened in the 1920s. Groucho Marx was an actor. He was famous, but not super famous at that time. And he was also very conservative with his money. And yet, um, he found himself sort of addicted, like everybody else, to trading. It became a national pastime. He found himself, practically living at a brokerage house in Long Island. And he asked the right questions. At one point, he asked one of the brokers about RCA, which everybody was, goo goo gaga about.
RCA is
Why
it was the Nvidia of the 20s.
totally. And he said, why don't they issue a dividend? As if they're so profitable, why aren't they? And of course, the broker said, Groucho, you don't understand. This is the future. This is the world. There's a new world order here. You got to buy into the future. And of course, he does. And then ultimately, gets, unfortunately for him and his family, a margin call that forces him to mortgage his own home.
Right.
And I think it's just indicative of his story is just so representative, just on a as a microcosm for what ultimately happened to so many people in the country.
Yeah. And this crash wiped out the country. This wasn't like the flash crashes we have today. Our bear markets are cute. This
Right.
really sank the country into this depression. And it took until I think 1954 for the stock market to get back to those levels. We're talking about a 90+%
Well,
drop. Why was it so devastating?
Well, it's devastating for two reasons. And I think it's important to actually make the distinction. It was devastating in 1929 for so many families because they had taken on so much debt. So when I said they had put down $1, but they still owed $10. So it wasn't just that the stock market dropped, and it did drop about 50% between October and November 13th. It was down from the highs, 50%. It wasn't just that you lost the 50% of equity you owned, it was that you lost so much more. And that's why people like Groucho Marx were mortgaging their homes. Interestingly, the stock market actually ended the year down only 17%, but so many people had taken losses, they didn't have any money left. They weren't in the market anymore. And then it was really a series of dominoes after that. The crash was really the first domino, and then a series of, frankly, bad policy choices by President Hoover, to some degree, President Roosevelt, by the Federal Reserve, which ultimately sat on its hands for most of the time. There was a policy choice at one point by Hoover to raise taxes in the midst of all of this, another choice to pursue tariffs, as you mentioned earlier. By the way, back in 1928, he was trying to get farmers to vote for him. How did he do that? He told them, I'm going to put tariffs on. So he felt that he needed to make good on his pledge. And so a whole sort of series of things were taking place that didn't necessarily have to happen. So I always say the crash didn't mean that we had to have a Great Depression for, the next 10 or 20 years. It was the first domino, and then a number of other dominoes that fell the wrong way. There was a period of time between the time that Hoover lost the presidency and Roosevelt was actually going to step into that role where they could have saved the banking system. And because of, frankly, a botched transition and a lot of politics behind the scenes, Roosevelt didn't want to do it, and Hoover didn't want to rescue the system either. So there was a whole number of things that took place. The New Deal then happens. That helps marginally, but in truth, by 1936, things had actually turned the wrong way again. And then, of course, an enormous amount of spending took place during World War II, which ultimately led us out of the Depression. But the answer, but not just the answer, one of the big lessons is in a crisis, if you've missed if you've missed protecting yourself on the front end, from a policy perspective, is the government really does have to spend extraordinary amounts of money and throw money at the problem, as politically unpalatable as that often is.
Yeah, and we've seen that, and we've seen that lesson learned. Ben Bernanke was, talking about that in the 2008, 2009 crash. We memorialized that with too big to fail. The government does step in. There is this so-called safety net, right?
Right.
Helicopter money, whatever you want to call it, that does happen. So I guess I'm sure you're getting this question left and right on this book tour you're on and talking about the book. Could it happen again? Or is there too much money sloshing around the capital markets today, Andrew, and are regulations tight enough today that it would never get that bad? What do you think?
Right. So I like to believe that it couldn't get that bad, that the idea of a Great Depression, that there are lessons embedded in this period of time and in this book that have been learned. Ben Bernanke, I think, learned a lot of them. He did his PhD thesis at Princeton on the Great Depression. And then what did he do in 2008? He threw money at the problem. So I like to believe that even if we had a problem, even if we did have a crash, if you will, where the equity market had a massive correction, that it would not turn into a decades long depression of sorts. Do I think that there are parallels around leverage? Do I think that there are parallels around some of these new products that are coming into the system? Do I think that there's indiscriminate spending in artificial intelligence right now, and that there will be a moment at which the investor class is going to say, excuse me, all of this just doesn't make sense right this second? And by the way, it may make sense long term, but not right this second. Sure. And then you'll have some kind of pullback. The question, of course, is where's the leverage in the system? It is the leverage that takes you down every single time. And I think what's less clear to me today is how complicated it is to even understand where the leverage is anymore, given the private credit markets and so much else.
That's exactly where I was going. You got tokenization, you got crypto and DeFi, you got the betting markets, the ICE making a big investment in Polymarket. You have
Right.
options, you have single day options. You have these exchanges, this exchange popping up in Texas that's going to trade 24/6 really tokenized assets. There is a lot going on. Sports betting, I believe, we're at the
Right.
convergence of all these things slamming together at light speed. So finding out where the leverage is going to be much more difficult, and people understanding
Well, I think
how leverage actually
that's the
works.
key. That's the key. And the question is, how connected is that leverage to the banking system? How connected is that leverage to the entire economy? And I think we will only find out when it happens, unfortunately.
Yeah, sadly we will, but I'm sure you'll be there to document it. The book, 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. Andrew Ross Sorkin is the author. Read the book. Get it as a gift
Thank
for
you.
friends and
Thank you.
family. We will link to it in the show notes. Follow Andrew. You can find him every morning on CNBC, but read him in the Deal Book. Read this book and all the great content that you put out there, Andrew. This is a masterpiece,
Thank you.
another masterpiece in all the great work that you've done. Really, really great to have you on the Investopedia Express. Thanks so much.
I appreciate it. Thank you very much. Thanks.
How good was that? Andrew Ross Sorkin. What a great interview and an interviewer. And this book is truly tremendous. You think it's going to be a dense history book, and it is. And the fact finding and the reporting that Andrew put into it and his team is really incredible, but it reads like a spy novel. It reads just like Too Big to Fail. So good question from GK, I should say. Will it crash in 2026? Any predictions or possible risks? Yeah, plenty of risks out there. And we're always around some sort of a market correction or a potential bear market. And it's been a while. This bull market, my friend, is now entering its fourth year, and they usually go 5 to 6 years, but a correction could happen at any time. I think to Andrew's point, though, when I asked him that question, a crash is a little bit far-fetched. There is a ton of capital in the system right now. There's a ton of safeguards. Businesses are in better shape than any period in history where we've had a big crash. We don't have over-leveraged consumers like we used to. Yeah, we got a lot of debt, but this is not 2008, 2009. Do we have a crash? Anything could happen. I would prepare your portfolio for whatever, but I would also just keep in mind, it's been a very long time since we've had an outright crash. We get corrections, we get bear markets. That's natural. That's a natural part of the game. But crashes, it's been a minute. And right now, I think we're pretty far from it. I don't know about next year, but anything can happen. All right, let's get to a little money in motion, because if you're looking at money flows like we're looking at money flows, you are watching money flow out of gold lately. We had massive outflows from gold last week, $7.5 billion. Doesn't sound like that much in the context of the total capital markets, but know this, it was $59 billion of inflows year to date into gold, the biggest ever. And last week's rush out of gold, that 5.9 billion, 7.5 billion, that was the biggest single week of selling in that asset ever in history. Big numbers mean big numbers. Where's the money going? It's going into cash. 35.5 billion according to B of A, 17.5 billion into bonds, and $3.5 billion into tech. Into tech stocks seemed like a pretty big and good bet last week. But why is gold losing its luster all of a sudden? It was the asset of the year. best performing asset of the year for sure. And it's still done pretty good, especially over the last few years. But what's going on? Well, that potential trade truce between the US and China, that's cooled tensions a little bit. It's got people flying out of the safety assets like gold into stocks. Some people picking up some cash as well, but into stocks, basically. You got rate cuts. We got a rate cut last week, a little baby rate cut. We might not get another one in December, but the fact that interest rates are headed down and to the right, pretty not such a bullish sign for gold. So that's why you see some selling there. And then risk is on, my friends. And when risk is on, investors say, let it rip. And letting it rip means not owning the precious metal. But just remember also that gold, very good safe haven asset, decent thing to have in your portfolio as a stabilizer for sure. A lot of people have it. A lot of people are super long it. But in the great words of Robert Frost, immortalized by Ponyboy C. Thomas Howell, in the great film, The Outsiders, so dawn goes down today, nothing gold can stay. All right, let's get set up for a really busy week ahead. What's coming on down the tracks this week? Because we got a lot of government reports potentially coming our way and some earnings. Let's take a look at the week ahead. Welcome to November, and you know what November is. It's the beginning of the best 6 months of the year for the stock market, historically speaking. Check out your stock market almanac there. My friend Jeff Hirsch and his team putting that together every year. This stretch, right? November to April, usually the best 6 months of the year for stocks for a variety of reasons. Doesn't mean it's going to happen this year, but we're coming into the month of November with some momentum and a lot of the win at the back of the equity market. If you think about interest rates, if you think about the fact that corporate profits are growing, that's what's going on right now. And corporate profits are growing, as we've been talking about. According to FactSet, the S&P 500 is expected to deliver an 8.5% return, an 8.5% increase, I should say, in earnings per share. That's going to make it 8 consecutive quarters of earnings growth. And everybody was worried about company profits falling off. Not happening right now. And that's what we're, again, here for as investors. We are here for profit growth, and that's what we're getting. We're going to get more reports on that this week. A lot of earnings coming our way this week with some of the most widely held stocks in our portfolio. Starting Monday, today, November 3rd, earnings from Palantir and Simon Property Group. Palantir, one of the top holdings according to the Investopedia Individual Investor Sentiment Survey. It's one of our top holdings, and it is one of the biggest stocks in the market. Tuesday, we got the chip makers coming out, Advanced Micro Devices, AMD reporting results, also Shopify and Uber reporting results on Tuesday. Wednesday, private payrolls report from ADP, significant because we have not been getting government jobs reports or a lot of government data lately due to the shutdown. So the private payrolls report, always very important this week, as we will potentially get a jobs report at the end of the week. Earnings on Wednesday from McDonald's, AppLovin, ARM Holdings, and Robinhood, among others. Thursday, the big Tesla shareholder meeting. He's already had Elon Musk, his compensation approved, but the future of Tesla is interesting right now. So we're going to be paying close attention. We've heard Elon Musk say, this is a robotics company. This is an AI company. Yeah, the batteries are cute and the cars are cute, but they're focused on the future. So let's listen closely to what they have to say at that shareholder meeting on Thursday, plus earnings from AstraZeneca, ConocoPhillips, and Airbnb. And then Friday, consumer sentiment for the month of November. We'll get that from the University of Michigan. And we are supposed to get the jobs report for the month of October, but that might be delayed again. We'll pay close attention to that, plus earnings from Constellation Energy and KKR. Really busy week up ahead. All right, let's get to the Investopedia indicator of the week. And why in the world was the Hindenburg omen flashing on Investopedia last week? A lot of readers flocking to our site in search of that term, the Hindenburg omen. Remember that great blimp crash back in the 1920s? Well, that's the Hindenburg omen. And why are people looking that up as it relates to the stock market? Well, according to Investopedia, the greatest investing education site on planet Earth, the Hindenburg omen is a technical indicator designed to signal the increased probability of a stock market crash. So to DK's question earlier, could we see a stock market crash? Are we heading for another 1929? Let me give you the 3 indicators that make up the Hindenburg omen, which is why people are probably searching for it so much lately on Investopedia. Because on October 30th, last week, my birthday, roughly 476 stocks hit new 52-week highs, while 170 stocks simultaneously hit new lows. That's about a 2.8% of all NYSE listed names reaching extremes on both ends. When you got extremes like that, you have what we call bad market breadth. You want to see most stocks rising, not just a few rising and a bunch falling. That's bad breadth. That's one of the indicators. Here's another one. The S&P 500 remaining above its 50-day moving average. That's happening right now. Stocks are near record highs, but you have really bad breadth in the market, and that's always a warning sign for folks. And then the final one, the McClellan Oscillator Index, that turned negative, meaning declining stocks are gaining momentum over advancing ones. So you got those three mini indicators making up the Hindenburg Omen. Got people searching for what caused the stock market crash in 1929. Well, read Andrew Ross Sorkin's book because it's all over that. So the Hindenburg Omen flashing on Investopedia, but I wouldn't worry too much about blimps, burning blimps right now. I'd be focused on the market. I'd be focused on the end of the year, hanging in there. And thanks to all of you for hanging in there with us. And a big shout out to Andrew Ross Sorkin for joining us on The Express. I'm such a big fan. I've learned a lot from him. Thanks to all y'all for watching. And special thanks to Fidelity Wealth Management for partnering with us on this episode. Hey, happy birthday. Thank you very much, Simon. I appreciate that. I had a great birthday. Got to spend it with family and friends, including my parents. Hey, thank you, Danny. Appreciate that. Thank you very much for the birthday wishes. Thank you. Hey. You guys are super sweet. We love you. We love the Investopedia Express listeners. And that was a good conversation. I appreciate that. I always learn a lot from Andrew Ross Sorkin. I think you will too. For those folks listening on demand here, we're going to put the link to Andrew's great book to buy that book in the show notes and all his other books. If you haven't read Too Big to Fail, that is a terrific read and a really good movie as well. So Andrew's got his mark all over some of the greatest business journalism we've been able to experience over the last couple of decades. And we look at great stuff from him in the future. And we will be bringing that to you and everything else from the Investopedia news team out here, sitting out there working on this week's earnings stories and all the news that matters to educated investors like you. And for me, Caleb Silver, the editor-in-chief of Investopedia, thanks so much for joining us. And we will talk again a little further on down the line.